New York City just became the testing ground for the most radical economic experiment in American history, and the results from the first week are already setting off alarm bells on Wall Street. We are watching a collision between ideology and mathematics that could wipe out billions in real estate value and redefine property rights for the entire country. But there is a specific, hidden calculation error in the new administration's tax plan that no one is talking about, a mathematical mistake so fundamental that it proves their entire revenue projection is a fantasy. If you think this only affects New York, you are dead wrong. The policies being deployed right now in the Big Apple are being drafted as a blueprint for your city, your suburbs, and your 401,000. We are about to break down the numbers the politicians are trying to hide. Welcome back to Tax Hack Pro. We dig into the financial reality behind the headlines so you can protect your wealth. Before we expose the accounting scandal that is brewing in City Hall, make sure you smash that subscribe button. The algorithm is trying to suppress financial truth, but with your help, we can keep this information flowing. Let's look at the timeline, because from a financial perspective, this is unprecedented. On January 1, 2026, Zoran Mamdani was sworn in as the 112th mayor of New York City. His platform was built on a foundation of aggressive government spending, free buses, universal services, and a radical redistribution of wealth. He sold a vision of a city where the government pays for everything. Yet less than 100 hours later, the exact opposite happened. On January 4th, the cost of living in New York City didn't go down, it went up. Public transit fares for subways and buses hiked from $2.90 to $3. For a working-class commuter, that is a direct hit to the wallet. Social media immediately caught fire. You had voters who cast their ballots specifically for affordability, now realizing they had been sold a bill of goods. One voter noted that they were promised a revolution in affordability and received a bill instead. Now, as financial analysts here at Tax Hack Pro, we have to be precise. Technically, the mayor does not control the MTA board. The governor does. This fare hike was baked into the cake months ago. But this highlights the first rule of political economics. Campaign promises often ignore fiscal reality. The mayor promised free buses without having the authority or the budget to deliver them. It is the classic free lunch fallacy. In economics, there is no such thing as a free bus ride. Someone pays, and usually that someone is you. But the broken promise on bus fares is just the tip of the iceberg. The real story, the one that should terrify every taxpayer in America, is the math behind his proposed tax plan. This is where we need to put on our accountant hats. The mayor's entire economic platform relies on a strategy to generate billions of dollars in new revenue to fund these social programs. He claims he can raise $4 billion by increasing income taxes on the top 1% and another $5 billion by raising corporate taxes to match neighboring states like New Jersey. Here is the problem. The revenue projections are based on a misunderstanding of how marginal tax brackets work. This is tax 101, but apparently it was skipped during the campaign strategy sessions. The United States and New York City uses a marginal tax system. This means you don't pay one flat rate on all your income. You pay different rates on different chunks of income. Currently, the city tax rates climb progressively. The proposal suggests adding a new fifth bracket of 6% on every dollar earned above $1 million. However, independent analysis suggests the campaign's revenue models calculated this 6% tax as if it applied to the entire income of a millionaire. That is not how it works. If you make $1,001, you don't pay 6% on the million. You pay 6% on the $1 over the limit. The difference in revenue between those two calculations is astronomical. We are talking about a multi-billion-dollar hole in the budget before the first invoice is even sent. They are counting money that simply will not exist under the current tax code structure. When you build a budget on bad math, you end up with a deficit. And when cities run deficits, they have two choices: cut services, which they won't do, or raise taxes on the middle class. This is the warning for everyone watching, regardless of where you live. When politicians promise to tax only the ultra-wealthy, you must look at their math. If the numbers don't add up at the top, the tax burden inevitably slides down the ladder to the upper middle class and eventually to anyone with a paycheck. If you want to stay ahead of these tax traps and learn how to legally lower your own tax liability, you need to subscribe to Tax Hack Pro right now. We are tracking these policy shifts daily so you don't get caught unaware. Now let's pivot to the most explosive development of the week. It's not just about taxes, it's about the fundamental right to own property. On his first day in office, the mayor appointed C. Weaver as the new director of tenant protection. To the average person, that title sounds benign, But in the world of real estate and finance, this appointment sent shockwaves through the market. Weaver is a celebrated figure in the Democratic Socialists of America. She is a tenant organizer who has spent years advocating for the dismantling of the current housing market. But within 48 hours of her appointment, the internet did what it does best. It dug up the receipts. Old social media posts resurfaced, and they paint a picture of an ideology that views private property not as a right, but as a problem. In deleted posts, there were calls for policies that would actively degrade the wealth of the white middle class. There were statements linking the very concept of homeownership to historical injustices and white supremacy. Let's analyze this from an asset protection standpoint. The person now in charge of housing policy for the financial capital of the world has publicly argued that the private ownership of homes is a tool of oppression. In a resurfaced video from 2021, Weaver explicitly stated that we need to transition away from treating property as an individualized good and toward a model of shared equity and collective good. Translate that from political speak into financial reality. Shared equity often means the government or a tenant collective has a stake in the property you bought, the property you maintain, and the property you pay taxes on. It is a direct attack on the fee-simple ownership model that is the bedrock of the American economy. But here is the twist that makes this story truly fascinating. While advocating against the concept of private property, reports surfaced that Weaver's own mother is a wealthy property owner. Public records indicate her mother owns a home in Tennessee purchased for over $800,000, which is now valued at over $2.2 million. So we have a situation where the policy director is attacking the vehicle of wealth creation, homeownership, while her own family benefits massively from the appreciation of real estate assets. When pressed on this contradiction by reporters, there was no substantive answer given. This hypocrisy is common, but the danger is real. When you have regulators who do not believe in the asset class they are regulating, the market becomes uninvestable. This brings us to the housing crisis paradox. The administration claims that the housing shortage in New York is due to greedy landlords and a lack of regulation, but the data shows the exact opposite. The crisis is likely the result of overregulation. Between 2015 and 2024, New York implemented massive interventions, rent freezes, right-to-counsel mandates, and the landmark 2019 Housing Stability and Tenant Protection Act. These were sold as pro-tenant moves. So what was the financial result? Did rent go down? No. Median rents in Manhattan have skyrocketed 25% since 2015. But here is the statistic that destroys the narrative. There are currently an estimated 60,000 rent-stabilized apartments sitting empty. Why would a landlord leave an apartment empty in one of the most expensive cities in the world? It comes down to return on investment, or ROI. Under the strict rent laws, landlords are capped on how much they can increase rent to cover renovations. If an apartment needs $50,000 in work to be legally habitable, but the law says you can only raise the rent by $80, the math doesn't work. You will never recoup your investment, so the units sit empty. This is warehousing, and it is a direct result of price controls. By trying to artificially control the price, the government has destroyed the supply. And now the new administration wants to double down on these exact same policies. From a tax hack perspective, this creates a deadweight loss in the economy. You have assets that are generating zero revenue, zero tax potential, and zero housing utility. It is economic suicide, and this is why the federal government is getting involved. Harmeet Dillon, a prominent civil rights attorney, issued a stark warning to the NYC administration. She noted that federal law prohibits discrimination based on race, and that includes discrimination against white property owners. The Department of Justice and civil rights groups are watching closely. If New York attempts to implement policies that specifically target one racial group's assets for redistribution, they will face a tidal wave of federal litigation. But why should you care if you live in Ohio, Texas, or Florida? You should care because New York is an exporter of policy. If these ideas, rent control, collective ownership, wealth taxes based on bad math, gain traction there, they will be exported to your state legislature next. We are already seeing similar rhetoric in cities like Chicago, Los Angeles, and even parts of Colorado. Furthermore, capital is fluid. Money goes where it is treated best. We are witnessing a historic migration of wealth. High-income earners are fleeing New York for zero-income tax states like Florida, Tennessee, and Texas. This creates a doom loop. As the wealthy leave, the tax base shrinks. To make up for the lost revenue, the city raises taxes on those who remain. This pushes the next tier of earners, the upper middle class, to leave. Eventually, the only people left are the very poor who rely on services and the very rich who are too stubborn to move, with a hollowed-out middle class. This migration affects you. If you are in a receiving state like Florida, your property values are going up, but so is your competition for housing. If you are in a donor state like New York or Illinois, your tax burden is about to get much heavier to cover the exit of the wealthy. Let's look deeper at the free bus promise, because it perfectly illustrates the lack of financial literacy in this administration. The mayor posted photos riding the single free bus line to LaGuardia Airport, dreaming of a citywide free system. But he ignored the balance sheet. The MTA is facing a fiscal cliff. They are projecting a $1 billion deficit by 2028. They are losing hundreds of millions of dollars a year to fare evasion, people jumping the turnstiles. The agency raised fares to plug a $350 million hole. Eliminating fares entirely would require billions in subsidies. Where does that money come from? There is no line item for it in the governor's budget. It doesn't exist, so the mayor's plan is to lobby Albany for money that isn't there, funded by taxes that haven't been legislated, based on math that is incorrect. This is the cycle of socialist economics that we have seen play out historically. Stage 1, promise everything for free. Health, housing, transport. It sounds amazing. Who doesn't want free stuff? Stage 2, claim the rich will pay for it. Use class warfare rhetoric to justify massive tax hikes. Present flawed revenue projections to make the budget look balanced. Stage 3, reality hits. The revenue falls short because the projections were wrong or the wealthy moved away. Stage 4, expand the tax net. Suddenly, the rich isn't just billionaires. It's the family making $150,000 a year. It's the small business owner. It's you. Stage 5, when the money still isn't there, target the assets. This is where the shared equity and collective ownership talk comes in. If they can't tax your income enough, they will come for your equity. We are watching Stage 1 and Stage 2 play out in real time in New York City. The transition to Stage 3 is imminent. The disturbing part is the justification used. When the policies fail, when rent control leads to fewer apartments, or high taxes lead to lower revenue, they don't blame the policy. They blame the system. They claim that the reason it didn't work is because they didn't have enough control. They will argue that because the private market is hoarding apartments due to the laws they passed, the government must seize the buildings. They will argue that because capital is fleeing, they need exit taxes or capital controls. It is a self-fulfilling prophecy of economic destruction. So what is the tax hack? What do you do with this information? First, you need to understand the concept of jurisdictional diversification. Do not have all your assets tied to one city or state, especially one that is hostile to capital. If you own real estate in a deep blue city with aggressive tenant laws, you need to calculate your risk-adjusted return. Is the appreciation worth the risk of rent caps or collective equity mandates? Second, keep an eye on the wealth tax proposals. Even if you aren't a millionaire today, inflation is pushing more Americans into higher brackets. A policy targeting the top 1% today often becomes a tax on the middle class tomorrow, as the threshold is lowered to capture more revenue. Third, get involved in the conversation. This isn't just about politics, it's about your wallet. The silence of the financially literate allows bad math to become law. If you are enjoying this deep dive into the economics of the news, please verify that you are subscribed to Tax Hack Pro. We are building a community of investors and taxpayers who refuse to be blindsided by bad policy. The situation in New York is fluid. The federal courts may step in. The governor may block the mayor's tax hikes. Or the city council may go along with it. But the most immediate indicator to watch is the real estate market. Watch the high-end listings. Are they sitting? Are prices being slashed? Watch the commercial real estate sector, which is already teetering on the edge of collapse due to remote work. If the city raises taxes on commercial landlords to match New Jersey, that could be the nail in the coffin for office buildings in Manhattan. And if commercial real estate values collapse, the city's property tax revenue collapses. And who makes up the difference? The residential homeowner. You. This is the ecosystem of finance. You cannot punish one part of the economy without causing ripples that capsize the other parts. The rhetoric coming out of New York City regarding white supremacy and homeownership is designed to delegitimize the idea of private property. It is a psychological operation to make you feel guilty for building wealth. Do not fall for it. Building assets, providing housing, and creating financial security for your family is noble. It is the engine of the economy. The administration's first 8 days have been a masterclass in economic illiteracy. From the bus fare bait-and switch to the tax bracket calculation errors to the appointment of officials who want to dismantle the housing market, It is a signal to every investor to proceed with extreme caution. We will continue to monitor the revenue numbers coming out of NYC. We will track the migration data to see where the capital is flowing, and we will keep you informed on how to position your own portfolio to survive the era of radical economic experiments. Don't let the headlines distract you from the bottom line. The math always wins in the end. The question is, will you be on the side of the equation that generates wealth or the side that confiscates it? Leave a comment below. Do you think these policies will spread to your city? Are you seeing local politicians using similar language about shared equity? We want to hear what is happening on the ground in your area, and share this video. Send it to your friends in New York, but also send it to your friends in Texas, Florida, and Ohio. They need to see the playbook so they can recognize it when it arrives at their doorstep. This is Tax Hack Pro, signing off. Stay savvy, stay solvent, and we will see you in the next video.